post-1980s relationship with international finance. And that second phase, of course, was a phase in which when we started, people said that India's had it now. I mean, the banks have burnt their fingers quite early, so you're not going to get any more foreign finance. So that period is over when you could pick up a telephone and get access to foreign finance. But I must confess, I was one of the people who said that at that point of time. Said that now we're going to be back to the days of. But actually, what was not calculated for was that, listen, I mean, the supply side push of capital is huge. By that time, all of those factors which you're talking about, oil surpluses, America behaving like a country which doesn't have a national budget constraint, accumulated capital with pension funds, all of this was even more true. So there was a supply side push of capital. Where are they going to go? I mean, are they going to go to Mauritius? Or if they went to Mauritius, are they going to go to Mauritius only to come to India? Or are they going to go to Mauritius as a substitute? No, they're going to come to the big countries. So they were going to go back to Mexico, they were going to go back to Brazil, they were going to go back to Argentina, they're going to come back to India. The only thing is, for a significant period of time, not forever, but for a significant period of time, they didn't come in the form of bank capital, debt, which came through the banking system, because the banks had indeed burnt their fingers. But because we changed our rules after the 1991 IMF loan, they now came in other forms. They came in particular, we know, in the form of portfolio capital. Now, we read only about that portfolio capital, or we read largely only about that portfolio capital which comes through the foreign institutional investors, and now qualified financial investors as well, who come and register and invest in the stock market. But we also in 1991 changed our definition of what constitutes foreign direct investment. We adapted, as part of our IMF new relationship with finance, we adopted the IMF definition of foreign direct investment. So if anybody came and held 10% or more of equity, independent, huge increase in access to portfolio investment for a significant period of time, which was more than adequate post-liberalization to finance our current account deficit, and therefore we started at some point building reserves. Now, the question to ask is, okay, so now we're getting access to foreign exchange, still on demand largely. We just say that, okay, we'll liberalize this, will you come? And that's what the government is doing now. I mean, first they allowed QFIs to come in because they want more foreign capital to come in. Then they are saying that, okay, we want foreign institutional investors to come and invest in debt markets. We are allowing, sovereign debt funds. We are allowing central banks to come and invest in government securities. We are doing also you keep doing things to say that, okay, the way I am signaling my demand for more is I change another rule. And each time you actually did get a significant amount, enough to be able to keep yourself going. We are not getting it today, but we were at one point of time. Sorry. The regime of accumulation changed. I would like to say that, yes, it did. The regime of accumulation changed. But the point is, it was not as consistent a change in the regime of accumulation as I think occurred in the period after 2003, because, this access to foreign exchange was still tenuous, uncertain. Some years we got a lot, some years we got less. I mean, we were just not the final destination of a capital surge, okay, despite liberalization. And to cut a long story short, basically we had two periods of growth. If you look at that period, we basically had one major period of growth, which was the period from 93, 94 to 96, 97. You go back and pick up the newspapers before the Pay Commission report at the end of the 1990s, which gave people a lot of access to accumulated areas, and you'd see that most people were writing about a country in recession. It was said that after 1996-97 in India had entered another period of recession. Now what happened between 93, 94 and 1996-97? Well, what really happened was that we had the opposite of an import substitution effect. That is, when you impose import substitution walls, what happens? Suddenly you're creating a vacuum. When you create a vacuum, there's a market which used to be serviced by imports from abroad. Those imports are not available if there's quantitative restrictions, or too expensive if we have very high tariffs. So domestic investment occurs, capacity is created to service that market. Okay. Supposing you happen to be in a world which has been protected for a long period of time and suddenly you liberalize. That too generates a new market. Why does it generate a new market? Because through this period, when you were keeping your economy completely protected, there were people getting richer, and some people were getting really richer. And they don't want to consume only things which you produce. So we happen to be in countries which pursue import substituting strategies. You happen to be in countries in which the pattern of production is very different from the desired pattern of consumption. People are desiring a set of commodities which you don't produce. So you go abroad and live there for 2 years and come back as an, under criteria which allows you to bring back your BMW car maybe, and or you go to the smuggle market, at that point of time, you were in any major city and there used to be a China bazaar, and you went to the China bazaar and bought your smuggled commodities, but how much can you do that? They were all small markets, I grew up in Madras, now Chennai, and you could go and buy, but how much could you buy? And if you wanted all the things you wanted, you couldn't get it. But suddenly if you liberalize and you tell these people, well, we are liberalizing, not completely, but we're going to allow a set of people to produce these things by importing the capital, the technology, the intermediates, the components, the raw materials required to produce these things. And if they produce it, you get it. And what do? You say that, of course, they'll produce it because my demand is price inelastic. You charge any price, I just want this thing and I'm rich, I'm going to buy it. So therefore, you suddenly have the release of pent-up demand of the upper income groups who wanted these commodities but couldn't get them in large enough measure, or even in any significant measure, and suddenly they got access to it. So you saw this complete change in the malls of India, partly because the rich were buying, but soon that market ran out. Okay, that market ran out because after that, that's a once for all demand. People who have this pent up demand and the money to be able to convert it into effective demand, and once you exhaust that, the market is exhausted, and then what do you have? You have the late 90s recession in India within this new regime of accumulation. But what we are really trying to say is that this was one in which you're using a supply side factor to push demand for a set of commodities which generates growth. What was the supply side factor? Import liberalization. Just as much as protection generates demand, import liberalization generates a market in demand, but it's a market which is not consistent, persistent. It runs out of steam. So that was the second period. Of course, it was facilitated also by the fact that suddenly you gave the Indian middle classes who were working in the state sector huge amounts of money in the late 1990s. So there was a second push. I mean, those of you in universities at that point of time and lived in hostels would have noticed at that point of time that there were very few cars in university campuses. After the late 1990s pay commission recommendations, campuses were full of cars because all teachers could afford to buy cars because they got these huge areas, They all went and bought these cars, I mean, I'm honest. I've seen it happen. I bought a car at that time. So, a new car. Earlier I used to have a 25-year-old second-hand Fiat. But, and so, so you generated some additional demand. So that's the second period in which you used access to international liquidity to generate periods of boom. Those were determined by specific supply side factors, but you didn't run up against inflation because you had access to this foreign exchange which allowed you to let the excess demand or excess absorption spill over into the current account. You had a current account deficit, but it wasn't a problem because unlike what some of us thought, you didn't only have to go to the debt market to get money, you could go to the equity market to get money, and you got a lot amount of portfolio capital, not so much, but enough to finance a current account deficit, particularly since India, we had our IT boom, which gave us a certain amount of foreign exchange, and we had our remittance boom, which also gave us a certain amount of foreign exchange. Last, and I'll stop with this, and I just want to show you a few graphs, is that there is a third period I'd like to argue, which is the period after 2003. You look at the graph, and you can see what I mean. Look at the way investment flows were coming in, both direct and portfolio, and you get to 2004-05, and look at what is happening. It just is another period. The supply side surge of capital into the domestic economy, foreign capital in the domestic economy, just changed after 2003-04. Why did it change? Well, many things. We changed the caps on foreign investment, which is allowed on domestic firms. We changed the rules with regard to FIIs. Now we allow aggregate FII investment, which is equal to the cap. Earlier it used to be 20% and so on of total equity. Now if a particular industry is allowed 75% of foreign capital, you can have many FII investors, all of whom add up to 75% of the equity, like for example ICICI Bank or HDFC Bank. I mean, these are not Indian firms, you know. It's just that there's no one single foreign investor owning shares to be able to be in complete command. Okay. Okay, that's the first thing which happened. You had a change in the. Therefore, you moved into a second phase. And the second phase is one. It was a phase in which, it's true, by that time the desire to implement the shift away from a regime of accumulation in which debt finance public expenditure was a major component of domestic demand was sought to be tamed in. It's significantly tamed in because we have a low or declining sometimes, or at least stagnant tax to GDP ratio, and we have a falling fiscal deficit to GDP ratio, which means that the fiscal stimulus is being held back. We can discuss that in significant measure. But you discovered another thing. You suddenly discovered that, listen, you can, learning from the lessons of 1993, or 94, 95 to 96, 97, that is, you can unleash pent-up demand so long as people have the money. Two, you can give people money in different ways. One way, of course, you can implement pay commission recommendations for teachers or for government servants. But there's a third way, which is the way in which capitalist countries have been doing it for a long time. You just give people debt. So you move from, let's say, middle of the 1990s to 2007, 8, look at the share of bank advances, which are retail advances. In fact, if you start from the 1980s, it's even more dramatic. And retail advances are what? Retail advances are lending for investment in housing, largest chunk, lending to buy automobiles, lending for credit card receivables, lending to students to be able to undertake an education, etc., etc. And you suddenly find that moved, I think in 1980-81, it was 3% of total bank advances. By the time you get to the late middle of the 2000s, or the noughties as they call them, you're ending up with something like 23%, 24% of total bank advances. And you look at what's happening to the credit to GDP ratio at that point of time. It's just soaring. So you have a soaring credit to GDP ratio, and you have a high share of retail advances to total bank advances, which basically means you're lending to individuals to go out and spend. Okay? So when they go out and spend, you're creating, so long as you can sustain this. I'm not saying that this is a resolved problem, but so long as you're creating another supply side driven substitute for public debt financed expenditure, which is private debt finance expenditure, which actually moves the line lower and lower of the set of people who could behave like the Indian rich did between 1994, 95 and 1996, 97. And you generate this demand. Generate this demand, you actually get growth which is even higher. Move in the period after 2003-4, everything changes. You have a structural break. You suddenly have corporate savings going up. You have the savings, GDP ratio and the investment GDP ratio going up. You have growth going into the 8 to 9% range, etc., etc. You have a complete new regime of accumulation with the source of stimulus being completely different. And of course, you don't have inflation because you have access to this liquidity. Okay? The problem is, the evidence seems to be that this has begun to dry out, but it's a very short period. It's 2 years. And this time around, I'm not going to stick my neck out and saying, oh, we have a debt crisis, you're not going to get access to foreign exchange. God knows. It's because the supply side push is still there in that world. Once, if and when the world economy gets out of its crisis, if and when it gets out of its crisis, you will actually have another supply side push of foreign capital, and some might come to India. But at the moment, it doesn't look good at all. So we moved through another regime of accumulation. And my last thing is, why did this regime of accumulation occur? And I do think it occurred because of one, as I said, of changes in policies with regard to foreign investment. But more importantly, and I'll end with that, I think it occurred because of one very important factor. And I'm just going to give you a quote. These are all other reasons why it occurred. And by the way, you can look at the way it affected the stock market and so on. It's incredible. Now, that's the period after 1990, completely different regime of accumulation. That's the period through the 1990s to 2003-4. The stock market goes up because you're now allowing portfolio capital to come in, but not all that way. That's the period from 2003-4. And you just changed the world, you just changed your whole economy at that point of time. Okay, so this is just the last quote. And what is that quote? In the 2003-4 budget, it's a quote from the budget speech of the finance minister. In order to give a further fillip to the capital markets, it is now proposed to exempt all listed equities that are acquired on or after March 1st, 2003 and sold after the lapse of a year or more from the incidence of capital gains tax. Which means you're saying that if you hold an investment in India's stock market for more than 365 days, you are in a tax-free enclave. This is not true of the United States. This is not true of most of, even it's not true of Switzerland, it's not true of Europe, etc. You created a tax enclave and actually created an environment where you not only gave the space for investors to come, but you said, listen, if you come, and because you come, you make profits, because then the stock market goes up the way it does, the rupee begins to appreciate, not now, but then, and you make a lot of profits, just take it all back home. Just convert it back into dollars and take it all back home. There's only one risk you carry, and that is the exchange rate risk. There's no other risk you carry, virtually. And the exchange rate risk is going to be taken care of by the fact that you're bringing money in, because it's going to keep the rupee appreciating. So I do think that besides intensifying liberalization through the 1990s, in 2003-04, besides the fact that globally there was a capital flow surge, India benefited in terms of being able to transit from the neo-Hindu or neo-Muslim or neo-Christian rate of growth of 5 to 6% to 8 to 9%, because you actually use the levers of state policy to shift it in favor of capital. And when you did that, you did it also for domestic capital, so that just look at this one graph. That is what's happening to wages as a share of value added in the organized sector. That's what's happening in terms of no, this is a share of wages and value added, and this is profit. So you look at what's happening to wages to value added, let's look at what's happening to the profit share. You actually use the set of instruments to shift it in favor of capital in general. It's really like an open mouth out there, and this is including managerial remuneration. So you gave managers some money so that they can send their children to Azim Premji University, and you created. You actually boosted this process of growth. You created a profit inflation-led process of growth aided by international finance, which actually depended upon a new stimulus as a substitute for public finance, debt-financed expenditure. And you're hoping over the last 12 months maybe that you'll be able to get back onto it, because suddenly you got derailed for a certain period of time. Okay, I'm sorry I exceeded my time. No, I can just have some water.
Why don't we do that?
Okay.
Then we can
5-minute break.
We'll come back here. And then
I'm Rahul from the University of Hyderabad. Sorry, I'm just going to give a bit of context about why I'm asking this question. Regimes of accumulation is a strong area of interest, and in a presentation I had given in my university, where I tried to argue, though not very tightly, that for me 2003-2004 was also a change in regime, and a lot of response I got was that there's a lot of convergence in literature. The 91-92 was a structural break, and 2003-2004 was the extension. Now, I was looking at regime in slightly different. I was looking at the fact that if a regime has to come in, how does the state break away from political constraints on starting a new regime?
So now, political constraints on?
How does the state manage to negotiate political constraints on bringing in a new regime? Now, 91 is fairly strongly argued that we had sort of liberal reforms through stealth, because there was Mandal Commission's politics going on, Hindutva politics going on. So liberalization was sort of pushed into the background, and no one really noticed at that the amount of rapidity of changes coming in. Now 2003-2004 for me at least brings an odd conundrum, because A, you have BJP coming out and talking about India shining, and they lose elections. You have a new UPA government which comes in with the left. How does a new regime of accumulation then come in, given that there was a lot of opposition to this change regime? I don't know if there's a right answer for that, but at least it seems to me that...
I normally get to that level of political disaggregation, to explain. But, there's one piece of evidence which stares us in the face. I don't know if it's relevant, whether it's explanatory or whatever. But you go back to 1981. First turning point using the IMF as instrument. Okay? We didn't need to take that loan. We took that loan to begin a change. Or at that point of time, try to begin a change. You go to 1991 and you go to 2003-4 after. You look at who ran economic policy in this country in one form or the other. There was Mr. Manmohan Singh. He was either Commerce Secretary, a Finance Secretary, a Finance Minister or Prime Minister. There was Montek Singh Ahluwalia. He was brought back in 2003-4, He had a good job. He was heading the evaluation office of the IMF. You had a whole host of people brought in as economic advisors who were either on lien from or had resigned from either the IMF or the World Bank. So, I don't think it matters whether the NDA spoke of India shining or didn't. I think this, in terms of the ability to be able to engage in a kind of policy capture as opposed to regulatory capture, which also happened, but policy capture, I think the change began in 1981. So, it was only what they managed to do at different points of time, and the fact that somebody became Prime Minister may be relevant. I don't know. And as I said, I don't normally get into this kind of.
Next question.
Hello sir, this is Shashwata from University of Hyderabad.
And sorry, and by the way, if you go by the media, there were two people who changed India, Narasimha Rao and Manmohan Singh, neither of whom were NDA. And Narasimha Rao with Manmohan Singh.
I was just wondering, when you say a loan, access to a foreign capital is supply determined or demand determined, how do you differentiate it? Is it just from which side it comes first? Is it that way determined?
No, listen, I'm saying, even now I'm saying there's a supply side push. But the point is, independent of whether foreign finance needed to recycle or not, in the period prior to, I'd say, mid-1970s, as far as almost all developing countries, South Korea was an exception because South Korea had an implicit sovereign guarantee of the United States, But, so they got a lot of debt. They took far more debt than they took FDI. But otherwise, if you look at all countries, they got capital either through the FDI route or they got capital through the development aid network route. And development aid network is obviously supply determined because you meet, the Paris Club meets and you decide, okay, and so you don't like a country, you don't give them. And you don't like a country not because, they're not democratic. Most countries you like are countries that are not democratic, And so, but basically there's a decision making network within the development aid network, which is why, you have all this talk about coherence and so on, because you're basically saying if one person begins to lend to Bangladesh, everybody begins to give aid to Bangladesh, and then you say that everybody goes and gives aid and they have their separate programs, so let's all sit together at a table in Paris or somewhere and have a common strategy since we're all going and giving money there. So in some sense it gets determined by their decisions. FDI obviously gets determined by the profitability decisions of foreign firms, so it's determined from the supply side. What I meant by demand side is that you enter a phase in which, okay, there's all this capital which is looking and they consider you a candidate in any case. But there's enough capital there which is willing to come and risk in your country for you to decide how much you want till such time as they're willing to come and risk in your country. So you can pick, as I keep saying, you actually do that. You actually just pick up a phone or you fly to Washington,
Two more quick doubts. One is you said that the boost that came from the richer class in terms of consumption, that is not consistent, this is just one short game. Why is it so?
No. I said the boost which comes from the pent-up demand of the richer class. Because pent-up demand, once it's met, okay, you might buy 2 cars or 5 cars or 3 cars or whatever it is, I don't know how many people buy, but that's it. Whereas, so you're moving from a situation where you have 1 or 0 to a situation where you meet your desired level. But once you meet your desired level, then every year you're not going to go back to that market, no? You'll go back at some point, but...
No, why I raise this question, because Prabhat argues it's the inequality and the consumption of the richer class nexus with the growth that that creates the circle of growth inequality.
Yeah, but what I'm trying to say is that you know, in the period after 2003-4, that's why I'm saying, you know, I'm saying there's a profit inflation growth in a double sense, I presume, which is why I also said, you know, that's the managerial class. You know, that the managerial class is not doing as badly as the wage earners, you know. I mean, it's the wages plus. I mean, it's what is called, you know, you get a thing for the wage bill and you get a thing of remuneration of employees, which includes the wage bill and the others. Now, so I'm saying that at that point it plays a double role. It plays the typical role in an investment function where high profits stimulates investment, either, you know, whichever way you want to look at it, and then the other is because of this the demand which profits give. I mean,
Wait, we come back to you if there is let other people
Sir, you have given this 3 stages, right? The first one being 1980-81, 1990-91, the second loan being a kind of extension of the same trend. I'm trying to understand this here. And 2003-4 being another thing with the whole credit side coming up very strongly. First of all, I'd like to clarify, is my understanding.
Yeah, I'm saying there are 3 breaks, 80-81, 1990-91 and 2003-4. But I'm not saying 1991 to 2002-3 is the same as 80-81. In fact, I'm saying they are very different, because the 80-81 to 1991 is a continuation of the earlier regime of accumulation without the constraint. That is where you have a state, where you have debt finance state expenditure providing the stimulus, but which doesn't spill over in the form of inflation, but in terms of a current account deficit, because you're in a position to finance the deficit because you have access to foreign exchange on demand. So, 80-81 to 1991 is a continuation of the old regime of accumulation. 1991 is when you enter a new regime of accumulation.
Okay. So then probably that takes care of one bit of confusion that I had, which is that during the 80-81 to 91 phase, despite the fact that we already had sort of taken the first loan and everything, the state withdrawal wasn't there because there was quite a lot of state public expenditure still going. 1991, you have the first this thing of state withdrawing and all that. I was trying to understand how that links up to the type of loan or the conditionalities taken. The difference is that there's nothing hush-hush about the conditionalities now. I mean, this is like all out clear in the open that you have to have fiscal controls and so on. So, which is why you need to have state withdrawal, is it?
Well, let me put it this way. First, you had the same conditions in the 80s and in the
exactly.
90s.
Yes.
You had the same conditions.
Yes.
Which I didn't go into, but which brings me. I mean, actually, if you look at the 1990s, the highest fiscal deficit to GDP ratio we had was in 1994. This is after the IMF conditionalities had begun, and before we had stopped taking more of the IMF loan of 1991. Both loans we didn't use in full. We gave it up. Okay. So 1993-94 was. So 1990s was also one in which the reduction or the movement to some fiscal deficit to GDP ratio target was slow. I mean, it really happened in the second half of the 1990s when we started getting closer to the 4 to 5% range, or 3 to 4, not 4 to 5% range. Okay. Which brings me to the second argument, the real argument, which is I don't think finally in a country like India, it's IMF conditionality which determines the willingness of the country to actually implement fiscal stringency. What really determines is the amount of legacy private capital. As you build the amount of private capital, accumulated short-term private capital or volatile private capital, which is accumulated in your economy, the need to appease foreign finance becomes greater. And foreign finance is not a political animal. The IMF is a political animal. You can go to the IMF and say, listen, I agree with you. We have to reduce our deficit. I know they're very angry with us, but our politics, at least we are able to do other liberalizations, so just give us some time. You can't go to Merrill Lynch or, JP Morgan or Morgan Stanley or whatever it may be, and just tell them that, listen, just hold on, our politics. They're going to say, I don't care about your politics, I just want something to happen. So therefore, you actually, and you have to ask the question, what's foreign finance's attitude to excess fiscal stimulus? And they don't like it for a number of reasons. One obvious reason is that, the youth who populate the offices of foreign finance are all monetarists. But that's a very low level argument. They are. They actually think that the reason they don't really like it is that, if governments go and borrow in markets in order to be able to finance expenditure, which is what a fiscal deficit is, then, you have an entity which is autonomous, which is not a pure profit seeker, which is entering a financial market. So they are not betting. They are not betting. They are actually entering there, doing it independent of determines interest rate. Now we know that Barclays can determine the interest rate. So they're always engineered. They're all set. So for these reasons, finance doesn't like a debt GDP ratio, and therefore you end up with a situation where you're forced to curtail it.
So the one of the big differences also that it's not now IMF directly that we are talking about. We are talking about ABC company or whatever it is that India has.
Let me put it, legacy, the size of legacy financial capital in a country, which you accumulated over time. It's not how much is coming in this year alone. Because you're looking at what can go out, and when you're looking at what's going out, you're talking about all which has come in and is still there.
My name is Vikhar Ahmed. I'm a journalist with Frontline. You mentioned that.
I'm glad.
In your presentation, you mentioned that early on, flow of international capital into India was determined by supply side. Yesterday, we had a presentation by Aditya Mukherjee where he briefly discussed the behavior of the Indian capitalist class towards independence and the Indian state's attitude vis-a-vis foreign capital. So I'm confused as to how can it be determined by the demand side when there is no scope for that at all. So like you mentioned, later someone could just call and ask for credit, but wasn't this curtailed early on? So when you say it was merely determined by supply side, I'm wondering there was no chance for it to be determined by the demand side. So am I correct to wonder? Or
No, what I mean by that is once you have the accumulation of excess liquidity in global financial markets, for reasons I mentioned when I was presenting, once you have this accumulation of excess liquidity, and there are few countries which are accepted as prime targets, and you have to be among the more developed of the developing countries to be accepted as among the favored targets, then it is possible for you, with of course providing some incentives. You have to change some rules domestically, you have to allow foreign firms to come in, etc. You have to do some things. But when you signal that I want there was the accumulation and then subsequent burgeoning of excess liquidity in the international financial system. And by liquidity, I don't mean real cash. By liquidity, I mean the ability to generate purchasing power, which you can then go and exercise independent of whether you actually truly have that money or not.
why weren't these signals given earlier through the 60s?
No, there was no excess accumulation of international liquidity.
Okay.
In international recycling to the less developed world occurred only through the development aid network or through FDI.
I was actually curious. My name is Malini, and I work for the research center here in Azim Premji University. My question to you is, throughout your presentation, I was wondering why did you leave out completely the political scenario that India had starting from 80s until mid 90s, because internally India was going through a lot of important political changes. There were caste-based mobilizations, religious-based mobilizations, which had a huge impact in terms of how the economic policies or foreign policies kind of shaped. So just wanted to know if you think there would be any kind of correlation between the political changes that were happening.
Well, part of the reason I didn't do it is I'm not competent. Besides the fact that I couldn't bring all that, and I'm not competent to speak on. But the way I look at it is, you know, you can interpret post Mrs. G politics, post Garibi Hatao, I mean, or from Garibi Hatao days, bank nationalization and so on. You can either interpret it as something which just occurred because, you know, some bunch of politicians changed their minds or fought with each other, or Nehru died. You know, you can interpret it as just being political accidents, or you can actually say that the party, like the ANC in South Africa today, the party which in some sense was the home of competing forces which played a role in the national movement, had lost its ability to win social sanction, to pursue what it was doing, independent of what was the rhetoric it engaged in. And I think that it's because of that the Congress became a highly centralized party, lost its mass base. You had the emergence of new forces, and you know, you had the ability of, besides you know, the fact that, you know, the Green Revolution threw up, you know, and brought certain castes more into the fore than they would have been otherwise under the old kind of institutional regime, etc. So, I mean, so the way I look at it is, what you did in policy was the result of what you were and what the economy was demanding, and politics in some sense mediated it. So not that I'm right, but by virtue of my training, I'm an economic determinist, okay, you know, and just by virtue of my training. But I do think, you know, for me, that's an easier way of understanding. I mean, I even don't, I don't think we can understand. I might be wrong. This is just, this is not an academic statement. This is just a statement of my feeling. I don't think you can understand the rise of Hindutva forces without the rise of India's new rich and liberalization. I mean, you know, because these kinds of tendencies are visible in other ways in other countries.
There's one question back there, and then we can come back to Hiran.
Yeah, you have to put down the bag.
In your entire discussion, it seems that supply side shocks or stimulus can lead to consumerist growth. So in 1993, it was the upper middle class of 80s, and then so on and so forth. Now, if you look at, you know, and the current government seems to be thinking that a new supply side shock can help new growth, and it's not mere coincidence that the supply shock is to be, you know, begun with the opening up of the retail FDI sector. Okay. Now the issue here is that how long can this consumerist growth proceed? There are two constraints which seem to be you know, now constraining the supply side financial stimulus. The first is that distributional issues are completely ignored. So you know, we feel that okay, we bring in FDI in retail, and then that lead to more FDI and so on and so forth. But the distributional impact of opening up the retail sector is completely ignored. This will lead to political backlash, instability, etc., which will have a negative impact on the growth. The second thing is that now the second kind of distributional issues are linked to for instance, you know, if you go to Chhattisgarh or any other resource region, more growth in India needs, you know, you need to harness your resources. Now the distributional issues in Chhattisgarh and the ecological and environmental issues in Chhattisgarh are again stalling growth. Now, so some of the companies, for instance, Tata and others are sourcing coal from Australia these days instead of sourcing from India. So there are limits, you know, within the country, distributional as well as ecological, which which seem to suggest that we need to put an end to the consumerist growth and financial stimulus based growth. Am I right or absolutely wrong?
First, let me first, by way of a caveat, I was asked to speak on international finance in India. So I actually haven't looked at a range of things which are happening to the domestic economy, which are undoubtedly related to this, but which are not central to the argument which I was trying to build. Point number one. Point number two is that, you see, it's not, I think when, possibly Professor Patnaik did, dealt with this, and he's written a lot about this kind of thing. But we know that one of the problems of analyzing a capitalist economy is, being a demand constrained economy, we have to find sources of stimuli which are exogenous to the system in order to be able to generate growth. Because internal to the system you can get cycles, but you can't get trend rates of growth. Okay, that's what Kelesky told us, a lot of people told us. Okay, so in the old world we had some well accepted and some not so well accepted exogenous stimuli. Okay, one exogenous stimuli, for example, which is well accepted, is net exports. If there's a country which is constantly exporting more than it's importing, that creates, it's using external markets, external sources of demand as an additional stimulus. So it's not really a closed capitalist economy, and a lot of capitalist growth can be explained with that exogenous stimulus. A second, people said, like Joan Robinson, and therefore Professor Patnaik wrote on Joan Robinson's theory and so on, said that, listen, you not only have external markets, but you can have an internal external market, which is public expenditure. Okay, when the state spends, it's like you're having an internal external market, which constitutes an exogenous stimulus. It's not part of the capitalist frame, even though you can endogenize the state in a model, but it's something which is outside, which is giving a stimulus. The third, less accepted exogenous stimulus is innovation. There are a set of people who believe that clusters or fundamental innovations actually just make people just go out and spend, and then generate incomes, and therefore you're in a position to invest more, and therefore you have growth and so on. Now, put in that kind of a framework, for example, you can, another perhaps controversial exogenous stimulus is land reform. And there are people who actually say that when you have a more equal distribution of land, you not only release the energies of the peasantry, but which increases, agricultural growth and therefore demand, but you create a larger mass market, and therefore you stimulate growth. But that's also, some people wouldn't agree that is, okay. In that kind of a context, what I am saying is that debt, injection of large volumes of debt, is in a temporal sense. I'm very clear about this, because you can't continue to do it. You always end up with a crisis. You either have the balance of payments crisis which developing countries had, or you have the crisis of the kind that the developed countries had, the subprime crisis and so on. But there can be periods of time when injection of liquidity and debt into the system can actually generate demand, which serves as some kind of an exogenous stimulus. In what sense? In the sense that it is not current income which is determining the level of demand, it is future incomes which is determining the level of demands, whether you're going to get those incomes or not. Okay? So when I said that, that there is this credit which is a stimulus, I was only using it in that sense. I'm trying to suggest, I'm sure it's going to be as controversial or more controversial than other exogeneses, but what I'm trying to suggest is implicit in the way a lot of people have been arguing about capitalism and its performance over the last decade and a half or more, is that, maybe 2 decades in some countries, is an understanding that you can actually have an exogenous stimulus which comes as a result of sort of de-anchoring contemporary demand from current income through the use of debt as an instrument, and that may not be sustainable. I don't think it is at all, but the point is it can serve. So it is in that sense I was talking about that. If you look at it in this sense, I don't know whether inequality per se would constitute a source of new demand. In fact, there used to be a time in the Indian literature where people said that inequality was responsible for the deceleration of growth in the mid-1960s onwards. Okay? And the problem with that argument was that inequality might explain a change in the structure of demand, but it cannot actually give you an explanation of change in the volume of demand. So you might have the textile industry maybe going down and the electronics industry going up, but aggregate manufacturing demand need not necessarily be affected unless it so happens that these people just keep putting their money under their pillows. So long as they go out and spend on something, investment or consumption. And even services was not a solution because, in fact, I think Wells, in an old article in the Cambridge Journal, basically said, this Brazilian model, people used to talk about the Brazilian model, which is the idea that if you have an increase in inequality, you can sustain growth. Okay, and he was trying, because you're generating, in fact K.N. Raj used that in his famous emergency article on Indian stagnation. You see, huh? Savings and also demand, that you skewed, some use sector hypothesis, Krishnamurti, But I mean, I don't know. I mean, it depends on where that thing gets spent. So you can either have no change in demand, you can have an increase in demand, you can have a decline in demand. In all probability, I would think you'll have no change in demand. It's just a change in the pattern of demand. Aggregate demand will remain more or less the same. So therefore, I mean, I do think inequality is extremely important in terms of providing incentives to invest, which is what I didn't have time to go through, which is the new regime of accumulation domestically as opposed to the international element to it, which I think is important. But I don't know whether purely from the demand side, it's an adequate argument. There's a lady at the back there.
Hello sir, I'm Minnie from ISEC. Sir, during the recession period, India managed to attract foreign capital flows. So that fits into your third phase, which you talk about. But after that, from 2010-11 onwards, there has been a decline in foreign capital flows. So do you see it as the beginning of another phase, even though government and RBI has been trying their best to attract capital flows?
I think we should distinguish between the capital surge of 2002-3 or 3-4 to 2007-8 before the crisis, and the capital surge which came after 2008-9. We lost capital. There was an exit, and then we saw a surge again. That was because international banks were just riding the yield curve. Governments and the Federal Reserve and central banks were providing them zero interest debt. Some of that debt they invested in their own stock markets, which were low and therefore came up a little bit. They invested in government bonds because governments are borrowing to save the banking system. So even if you get a 3% rate of return and you borrow at 0%, that's a huge rate of return, And some of that money came to countries like India. It came to Thailand, India, Brazil, many emerging markets, because you still could make enough profits despite the uncertainty when you're borrowing at 0%. So this little surge which we saw 2009-10 and to a certain extent 2010-11, but which we are now getting worried about starting from 2011-12. Even 2011-12, as far as India is concerned, if you add both direct and portfolio investment, we don't do too badly. It's only portfolio investment which has come down significantly. But if you add the two, and as I said, you can't distinguish so clearly now between direct and portfolio investment. So I would say that, that is a peculiar thing. It was created because of the nature of state policy in response to the crisis in the developed countries. So I think after 2008-9, we have entered a new phase, which might change.
Hi, I'm Shalini. Going forward, at least in the short term, how do you think how things are going to change? Is that phase going to continue?
No, at the moment we are having a problem. Which is why growth is slowing down. He mentioned, for example, FDI in retail. I don't think FDI in retail is being sought to be done to create new demand. FDI in retail is being sought to be done in order to tell foreign investors, please come back. Kaushik Basu was so open about it. He says that you do one or two of these big ticket reforms and you'll get the foreigners coming back to your country. But I suppose the question which comes out of the current environment is, listen, obviously there is some relationship between our access to foreign finance and our abilities to sustain growth. And what I was trying to do was really look at the kind of linkages which generate this relationship. Why should money which comes into the stock exchange and trades in the secondary market really doesn't contribute very much to the primary market in investment, why should it matter for growth? So there must be some other set of relationships which determine this. And if you look at those set of relationships, at the moment things are not good. But as I said, I don't know, tomorrow you don't know what happens. Supposing the European Central Bank just decides that it's being foolish and just starts printing euros like nothing on earth, things might change.
I think there's a question. Okay. None here, and then we'll start doing
You said that it is not primarily because of international forces, maybe like not because of the IMF's conditionalities, but because of India's response to them that, these new policies are happening. I was wondering because in 1990-91, the second loan that India took, and the conditionalities were all there out on the table, and we did what was required. Following from that, we could not very well have gone back on things when the WTO was established. And that opened up a lot of, more of, those other international forces. So to what an extent can one now say that this is India talking and not the, not international forces, not the WTO? I mean, in the sense, who is responsible?
I agree with some people who say that, there's truth in saying that there are many things which the WTO constrains you from doing. Okay, if you go by the law, there are many things the WTO constrains from doing. But I agree with a set of people who argue that this argument that now you can't do very much, you can't have industrial policy, you can't do certain things in trade, you can't do certain things on IP, intellectual property, because WTO doesn't allow you, is actually either a propaganda campaign or it's the work of lazy bureaucrats who don't actually want to go and check out what the WTO lets you do and what it doesn't let you do. Okay, I mean, for example, just look at the judgment. Look at the judgment which came on that drug, just now, the cancer drug, Nexvar, whatever, that company which actually went to, and Korean, just before he stopped being drug controller, basically said that, go to hell, they are allowed to produce this under the compulsory licensing requirement, India is completely right to do this, and you're okay. Now, maybe at one point when somebody went for a compulsory license, there could have been a set of people who basically said, no, you can't get a compulsory license in this, it goes against WTO law. Okay. The second point which I want to make is that, how many countries actually follow even what the WTO doesn't let you do? Very few, I mean, it depends on you, it depends on your guts. If you do it 20 times, maybe you'll get away with it 16 times and lose it 4 times. Just do it 20 times and take the 16, And, so this is, I think, a way in which those who want to ensure that policy doesn't change, earlier they used to say the IMF doesn't let us do it, now they say the WTO doesn't let us do it.
Myself, Suresh from Hyderabad University, and due to the present crisis in Europe, the demand for the dollar has increased as a reserve currency, because it's a globally reserve currency. So, but what is the future of the dollar? Because American economy itself is in crisis. So
that's a different presentation, but yeah, very quickly, listen, I think from the 1970s, ever since American manufacturing lost a significant part of its competitiveness, and ever since America lost the Vietnam War, there are reasons, and of course America broke the relationship between the dollar and gold in early 1970s. If you look at it purely in terms of conventional interpretations of what are required for a reserve currency, the dollar shouldn't have been a reserve currency. So we have to begin to think about unconventional reasons why a country's currency is a reserve currency. And that is, if all countries which matter, in some sense, secede the right to police the world to one country, in some sense, that is the most secure currency, because it is the one which polices the world for you. So who's going to trust the euro if you can't even put together an army which can do anything in Afghanistan? I mean, look at what NATO forces do in Afghanistan. Nothing, So I know, till such time as America's position as a military hegemon is challenged by I don't know whom, I don't see any other currency coming up. If the experience of the last 25 years is any indication of what determines, as opposed to theory tells us, what determines why a currency is the reserve currency. And which is why I think all this talk about SDR being a reserve currency is completely bogus. Yeah.
I have one more and then we'll come back. We have time. We've got 15 minutes. So go ahead. Go ahead. There's no one else in line right now.
Yeah. Sir, one I wanted to ask is, after 2003-04, as the foreign inflow has increased, I was wondering how much it constitutes of the total investment in India, how much proportion? Because you also said saving has increased in Indian case. So,
well, I don't remember the exact figure, but it wouldn't be more than 7-8% of our.
So it was the growth. Then can we say that the growth was not because of?
But you are accusing me of having made an argument which I didn't make. I didn't say that foreign investment drives growth because it finances investment. NSS Narayana and T.N. Srinivasan made that. I didn't.
Yeah. And sir, there are two more queries. One, you said that the growth.
I know. I betray a clan by speaking of supply side factors, but I haven't betrayed it that much.
Yeah, you made a point that growth stimuli has to come from outside. So can it not be endogenous? The argument of growth, furthering growth itself, or how do we understand extended reproduction without some exogenous stimuli?
No, you should have asked Professor Patnaik this question. He's just written a paper last month, I think, or 2 months back. But the point is, there's two things. One is, when you generate an inducement to invest and then investment occurs, okay, then you can say that investment generates income, which generates demand, which generates more inducement to invest. So people who are, so you have a multiplier effect and then you have the accelerator effect, okay, and a combination of the two gives you growth models of various kinds depending on how you combine them. But people who talk about the exogenous stimulus are talking about that normally, when the combination of the multiplier and accelerator operates, you can only explain cycles unless there's something which comes and gives a push, and then the operation of it gives you more growth than the initial push warrants. But the point is, you wouldn't even get onto a trend as opposed to a cycle unless you have the exogenous push.
Also, sir, you made regarding the deceleration, industrial deceleration, that you are not very comfortable with the inequality argument, but because that need not necessarily lead to a fall in the total demand. But sir, then what about the argument of effective demand problem led by inequality?
Well, see, supposing you say that inequality results in delivering incomes, this is an old argument. Kane Raj used to use this. Of course, you're too young to know. Kane Raj used a version which Joan Robinson had, which basically said that the problem in countries like India is growth tends to slow down because people take, there's income which goes to the rich, and the rich go and put their money in land or gold. The rich don't go and make productive investment, and therefore you don't have growth. That generates, people like him and him would know these things better. That generates a corner solution, Then you would have everybody putting their money into, because price of gold and land will keep on going. People will keep on putting their money there. At some point of time, all the investment would be in gold and land at the margin. That's unsustainable. Then who's going to actually go and buy this gold and land if everything is already deposited there? So, unless you have an argument which suggests that when you have an increase in inequality, that the money which accrues to the rich is actually neither consumed nor invested. Okay? Not just by themselves, but by the system, because I can get money which I go and put into the banking system, and somebody else might take the money and invest. But supposing I just take it and put it under my pillow, then neither can anybody else access it, nor am I using it. Then you might be able to say that an increase in inequality necessarily leads to a shrinkage of effective demand. But otherwise, I am not able to understand. I mean, I'm sorry, my ability to understand this argument has been not, you're not the first one who's raised this, but I just am not able to understand what these people are saying, you know. There's one thing you can say, that listen, when import substitution possibilities exhausted themselves, people attributed it to increase in inequality, whereas actually it was the exhaustion of import substitution possibilities. So, you know, it might be that you're using the wrong argument to explain something which was actually occurring. But
any other questions from the students? So, because Vamsi has a question, and we can, if you have a question after Vamsi's, we can go back.
now I'm being put to test. What?
No, I just want a clarification, because you use the expression regime of accumulation. I don't know if Rahul already raised the question. You know, broadly, you know, in the literature at least, regime of accumulation is a composite set of relations where you look at the capital-labor relation, you look at the market states, and you know how they are playing the relative role in the overall economy. What's the interaction with the external sector? Then what are the behavioral norms that are being promoted? That's how regulation school or social structures. The way you employed it, it seems a little slightly different. If you go with the regulation school kind of approach, maybe you have two regimes of accumulation, pre-91, because the break you know, happened in 91. 80s is not really a break, although you know there is a push towards a break. And then 2003-4, what happened post 2003-4 is a continuation of the same regime with some additional factors you know, emerging in the story about how, you know, the structure of aggregate demand changes or effective demand changes in the economy. I'm wondering if you know, you are using it differently, just for clarification, so that you know when they connect to the literatures.
You know, well, first I agree with you. You know, a regime of accumulation is a multiple set of forces operating in a conjuncture which describes it. Okay, it describes it. But why does a regime of accumulation matter to the kind of argument I'm trying to make? You know, because I think there are holes here, but that's inevitable. I mean, you know, I'm sure they'll all work on it, and you know, there'll be other arguments and so on. But what I'm trying to do is to say that, listen, I cannot explain why even a backward sort of backward economy through a gradual and painful process is traversing a path which is half capitalist. I cannot explain how that happens unless I'm able to explain what induces investment in this kind of an economy. Okay, so all these forces which you're talking about, I think should finally go in different ways into, in some sense, generating, crudely put, some kind of an investment function, which tells me why investment actually takes off and occurs. Okay, and so when I'm basically trying to say, is there a change in the set of forces and therefore in the proximate stimuli to invest or to induce investment, which occurs in quantities or in quality significant enough to say that, listen, I can say that this period is fundamentally different from this period. Okay, so that's what I mean by a regime of accumulation. And as I said, so somebody says, why doesn't politics enter your picture? Well, I do think politics should enter the picture, but the only thing is I can have an argument which says that things are induced from the political side, or I can say that politics only reflects to me the set of factors which in that conjuncture is inducing this kind of investment path, you know, or this growth trajectory. Okay. That having been said, so that's what I mean by a regime of accumulation. And
one more from Vikas, and then if we have time, I'll ask a question. So, to Vikas. Does someone have a mic? It's coming back.
So we'll have Vikas, then we'll have you, and then we can stop.
Yes.
I'm exhausted completely.
I'm sorry. I'm sorry. It was
Main point that FDI in detail is being introduced or sought to be introduced to signal to the international markets that we are open again.
Not that it's a workable signal, but they believe it is.
They believe it is. But you see, if you look at these statements of Montek, Singh, Ahluwalia, or anyone, they say it's going to create more jobs, it will lead to more demand, it's going to lower the prices of goods sold, and again it will lead to increase in demand. So they are not completely ruling out the demand side part of the story. In fact, a number of
But do you think Montek believes what he says?
No, he doesn't. That's a different story. But the way they are trying to convince people and politicians and others, the demand side is a strong argument there. It's going to create more jobs. It will not. It's going to create lower the prices, improve the quality, etc., etc. So even if Montek, Singh and Kaushik don't believe in what they are saying, they're saying it, and the very fact that it is being...
No, but listen, listen, supposing you take anybody's argument who advocates economic liberalization in any country, including, of course, India. They'll say economic liberalization has to be undertaken because that will generate growth. It will generate growth which is labor intensive, so you'll have more jobs, you'll have growth without inflation. Finally, anything you advocate in an economy which is characterized by a demand constraint, high unemployment and a tendency towards stagflation, you have to say it will resolve all those issues, So I don't know what, that doesn't mean that's not what I'm looking for. I'm looking at what, one is, I can tell them that what you're talking is nonsense. The other is I can ask the question, okay, they might actually be talking nonsense and may believe it or may not believe it. But after all, they are representatives of capital. Why are they doing what they're doing? Right or wrong? And I don't think they're doing what they're doing because they think it's going to give you jobs and growth. And they're thinking that the savior for this country is being in the pockets of international capital. And if they take you out of the pocket and throw it away, you have to say, listen, I'll come back with another lollipop and put me back into the pocket. So you can take the lollipop. Now that's it.
Okay. I'll speak loudly. So,
no, you can.
We're making Chandra. Wanted to thank you for a really, really interesting placing of India in global finance. One of the things that I think because it's such a vast topic, you weren't able to get to, which I like some sort of discussion, even if a little, is to do with actually the management of capital flows. About a month ago, I was listening to the Chilean finance minister, really wide-eyed terror when he was talking about what he called a wall of liquidity coming in from the West. We face this issue, and it has some theoretically and actually practically, it has some deflationary effects. And I was wondering, just for the students itself, if you would speak a little bit about that, about reserve accumulation and so on. It may not be something that's widely
Well, first, just to put the context on the table. For an economy which is, of course, running a current account deficit, and which is a problem, but which is running a current account deficit which is much, much smaller than it would have been, but for two major inflows. One, the inflows which come in outside the merchandise trade in the form of services exports, and two, in terms of remittance receipts. You have a greater, the point at which foreign finance starts getting worried about you, as they are now getting worried, because once they begin to get worried, the problem is to stop the cumulative increase in worry. But if they don't get worried, then you're okay. And for a long period of time, they didn't get worried in the case of India, not because India didn't have a current account deficit, unlike, say, China, which doesn't have a current account deficit, is because of the fact that you had these flows, which were giving the system some maneuverability. Point number one. Point number two, I do think that, managing those flows was done much better in India than in many other countries. For example, if you look at the problem of having to sterilize those flows, not because, it increases money supply when the assets of the central bank increases, liabilities have to increase, so money supply increases, and that automatically creates inflation. I don't think so. But it increases liquidity in the system, and that has many, many effects. And you know, if you happen to be in a world when you are having this inflow, you're forced to go into the market to buy this up because you're managing the exchange rate, and you did it well for a very long period of time, where you didn't permit too much appreciation, so you maintained it relatively competitive, let us say. But on the other hand, you didn't have to just get rid of all your ability to be able to, in terms of monetary management. But even when you were doing this and generating these large increases in assets, first, the problem was that you had got out of a period when central bank was accumulating a large amount of government debt. If you had a large amount of government debt, then it makes it easier. So a lot of us said that, listen, look at what's going to happen. They're going to run out of government debt to sell, because that's the way in which you are externalizing it. Okay, but then they did the market stabilization scheme, which for example, if you go to China, they don't have they have another version of the problem. But there, the central bank actually issues securities when it wants to engage in stabilization. Here, the central bank doesn't issue securities. But it thought of the market stabilization scheme, which actually is a crazy but a very intelligent idea, where you basically say that I have the right to issue these securities and keep trading in them. So long as it sits with somebody, the government pays interest. So long as it sits with me, you don't pay any interest. So you put some burden on the finance ministry, but on the other hand, you don't. So I do think that the fact that colonialism left us with a reserve bank, and we had long years, the management was significant. So we shouldn't. I'm not saying that there aren't parts of policy during the liberalization era which were not.
No, I wasn't suggesting. I was just giving some.
So I do think that the management element is. I really think the only problem, only major management problem has been that whenever we have excess reserves or perceived excess reserves, then what we do is we try to liberalize outflows. That's when we allowed resident Indians to take money abroad for capital account purposes, and now you can take 200 million per head per year. So if you're a family of 5 and rich enough, which many Indians are, significant number in number terms, you can take $1 billion abroad a year. You take $1 billion abroad a year over 10 years, that's $10 billion, and you're perfectly legally allowed to do that, So, you do that when you have excess reserves. On the other hand, when reserves are going down, you then liberalize in order to bring in more money, to increase legacy capital. So I think the real deep problem with managing our relationship with international finance is that either way, when it's good for us or when it's bad for us, we move in the direction of liberalization. Whereas what you're actually arguing is that sometimes it's necessary to step back, to put in capital controls, like Chile did and so on at one point.
Well, please join me in thanking Professor Chandrashekar very much for wonderful. So lunch is ready? Okay, so but please, you can start heading out. It should be ready pretty soon. We should be back here by 1 to start the session at 1. So please come here at 12:55 at latest. So I'll find out. Thank you very much. I'm sorry to have exhausted you. They were